Hey traders, so today I want to show you how to identify the fair value gap that works. So normally in the market when there is a high momentum, normally the market leaves some imbalances behind. So those imbalances, we have two types of imbalances that normally the market leaves. So we have number one, we have fair value gaps, and then we have number two, we have breakaway gaps. We have breakaway gaps. So these are the two imbalances that normally are formed in the market. So today I want to show you fair value gaps that normally works. Most of the time it works. So the first thing you have to identify, you have to know the difference between breakaway gaps and the fair value gaps. So in this, when we look at this movement here, this is a bearish movement. So in this bearish movement, there is an imbalance created here. There is this imbalance. This one is in balance. Also we have this one. So these are the two imbalances that are created in this movement. So we want to see which one will work between the two. When you look at the two imbalances, so we have this one. Let me just this one. Okay, so we have this. Let's say this one is number one. This is number one. And then this one is number two. That is number two. So we have the first imbalance and then we have the second imbalance. The first imbalance, this is a breakaway gap. It is not a fair value gap. Reason being, when we see the first candlestick, this is the first candlestick, this is the second candlestick, and then we have the third candlestick. The third candlestick is closing above the first candlestick, and the fourth candlestick, it is creating another gap there, which is another imbalance. So when you have an imbalance here and then another imbalance is created here, then it means that the first one is a breakaway gap. Normally the price doesn't go back to the breakaway gaps. It normally returns to the fair value gap. Let us look at the number two, the imbalance number two. When you look at number two, we have the first candle, the second candle, and then we have the third candle. The third candle has closed above the second candle, but when you look at the fourth candle, it does not leave any space here, any imbalance here. It has closed the gap. So the probability of coming back here and then continuing with the bearish direction is very high. So that movement is most likely to happen. So you have to know difference between the two. Let us look at the second scenario. We are having a bullish movement. In the bullish movement, also we are having imbalances left behind. So we have the first imbalance here. We have that one, and also we have this one. Have this. In fact, we have three. We have this one, and then we have also this one here. Yeah, we have this one. So here we are having three imbalances. We have the first one is this one. Let's say this is number one. This one is number two. And then we have this one is number three. we have number 3. So we have 3 imbalances here. When you look at the first one here, the first one is a breakaway gap, the second one also breakaway gap, and then the third one now it is a fair value gap. Reason being, when you look at the first one here, candle number 1, 2, 3. When you look at the fourth candle here, it is creating another imbalance. So we said the price cannot go back to 1 when already it has created another imbalance. Again, we look at 2. We have candle number 1, 2, and then 3. When you look at candle number 3, it is closing above candle number 2, and then candle number 4 is forming another imbalance here. So meaning the price cannot come back again to number 2. I hope we are together. So when you look at fair value gap number 3 now it is a fair value gap. You have candle number 1, 2. Candle number 3 is closing below candle number 2. So this one, when you see this one has the highest probability of happening. The price is most likely to just retrace back to here and then continue with the movement. It has the highest probability of happening. So you have to know the difference between the breakaway gaps and the fair value gaps. So this is the most likely scenario. But when it happens like this, normally you have to check on a higher time frame to see if there was another fair value gap which was created in between here, because we have the liquidity void here is too big. So normally price will come. Even if you are entering the trade here, just enter and then exit at the liquidity point above here. Okay, so I want us to look at gold. This is gold daily time frame. I want us to look at some of the sample if you can find some. So we are looking at gold. This is daily time frame. When we look at daily time frame, we have here, let me just expand it so that it become clear. We have here, we had this breakaway, this is a breakaway, and then we had this fair value gap. Let me just highlight it. We have this one here. That one there. This one, we had candle number 1, 2, 3. Number 3 closed above, but number 4 retraced back to the fair value gap and then continued. We have also this one here. When you look at this one, we had a breakaway gap here. The price never came back here. So we had this 1, 2, 3. When you look at candle number 3, which formed this fair value gap here, it closed below candle number 2, and then the price came, tapped in, and then continued. Here we just had this one, and then candle number 4 came back, tapped, and then continued. There's another example, a clear example here. You have this one here. When you check out this one here is a breakaway gap up here, and then we create a fair value gap. The candle number 3 closed above, but 4 came back, retested, and then continued. And then we have again another one here. We have that, this one. When you look at this one, there was a breakaway. This was a breakaway gap. The price never came here. So we formed a fair value gap here. Candle number 3 closed below candle number 2, and then it came back, retested to that retested to that region and then continued. Same here. So this was just repeating itself. Normally we have these opportunities in the market, so just have to be patient to find the opportunities. Yeah, we have again this one here. So this one, you see, it was a breakaway gap. The price never came back to this. It just traded to this one and then continued. So you just wait for the price to come back, retest into that area, you find confirmation, and then enter the market. That is what you're supposed to do. We have again another one here. There's a small one here, like that. So this was breakaway, this was breakaway, and then when you look at this one, candle number 4 came back, retested, and then it continued. It cleared liquidity up before reversing. So that is how you enter the market. See you in the next video. That is how you analyze, and then you find confirmation to enter the market.